Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Pan American Silver stock so we can determine if it's a buy or a sell. Pan American Silver is a mining company with operations in Mexico, Peru, Bolivia, and Argentina. It is one of the world's largest producers of silver. The company is headquartered in Vancouver, British Columbia, Canada, and was founded in 1994. Let's get started with the model. This is a mid-cap company, $6 billion market cap. They're trading at $16 a share, and they have 368 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They had their most free cash flow in 2024, $284 million, but it's a big negative in 2022, negative $243 million. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's also high in 2020, a big negative in 2022. Revenue is a sales for the company, and that's fairly steady, $1.35 billion. It peaked at $1.6 billion, then down to $1.5 billion in 2022. Obviously, this company is at the mercy of the price of silver, because if the price of silver in the market, the spot price, is really high, then their revenue and cash flow will be high. But if the spot price is low, their revenue will be low, and they'll probably lose money. They recently released their first quarter earnings, and for the first quarter of 2023, revenue of $390 million, down from first quarter of 2022, $440 million. I'll provide you a breakdown of this revenue number. Of the $390 million of revenue, $250 million is from gold, $135 million from silver. Of that $135 million, $44 million is from their mine in Mexico, $39 million in Peru, $30 million in Bolivia, and $24 million in Argentina. Of the $254 million of gold, $63 million in Mexico, one mine in Peru is $83 million, the other mine in Peru is $41 million, and Canada is $68 million. Of the $390 million of revenue, $278 million is from refined silver and gold. Because usually gold and silver is mined together. The ore usually contains some silver and some gold. Actually, the ore usually contains many other metals, like zinc, lead, silver, copper. But of course you want more gold because it's worth the most. They had $30 million of zinc, $53 million of lead, $15 million of copper, and $14 million of silver. The only two metals that increased from last year are zinc and lead. The rest decreased. Their operating income was $77 million, so they had about $313 million of operating expenses. Net income was $17 million, down a lot from last year of $77 million. So earnings per share are only 8 cents compared to 36 cents last year. Even though they had $16 million of net income, they generated $51 million from their operational business. Because net income is weighed down by things like depreciation. Depreciation is a non-cash item, so we add it back here. The dividend per share is 10 cents, down from last year of 12 cents. In the first quarter, they produced 3.9 million ounces of silver, down from 4.6 million last year. 123,000 ounces of gold, 11,000 tons of zinc, 5,000 tons of lead, and 1,200 tons of copper. It cost them $12 per ounce to mine the silver, and they sold it for $23. Last year it was cheaper to mine, $10, and they sold it for more, $24. But the all-in cost to mine the silver is $14 when you include all the miscellaneous costs. And they are diluting the shareholders. Last year they had 210 million shares outstanding. Currently they're at 364 million. Let's look at the capital structure. $2.2 billion of equity, $227 million of debt. They're 91% equity, 9% debt. Their net debt is $84 million. So they have $143 million of cash on their balance sheet. I gave them a WACC of 9.3%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $6.8 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $6.1 billion. We divide that by 368 million shares. And we get a calculated stock price of $16.56. They're trading at $16.29, so they're trading at a 2% discount. It's a really small buy according to the model. Simply Wall Street is way higher than me. They're at $37. They say the stock is 56% undervalued. 3 analysts priced this stock and the average price target is 21, the low is 15, the high is 24. Another 2 analysts priced this stock and the average price target is 24. They say the stock is 50% undervalued. This is where the stock has been trading since '96. So you can see it's all over the place. It looks like it was about $1 or $2 in 2001. That's during the dot-com crash. And it actually broke through $40 a couple of times. Right before the Great Recession, it looks like in the beginning of 2007. Then it fell to about $11 in 2008. Then ran up past 40 again. It got pretty close to 45. That was in 2011. Then in 2015 it got down to about $6, $7. Then a huge spike right after COVID, getting up to about 36, 37. But you can see they did start paying a dividend in 2010. And they've been pretty consistent since then. This bottom chart pinpoints their revenue by quarter. So in the first quarter they had $390 million of revenue. In 2021 it was a little higher, but before 2020 their revenue was around $200 million, so they doubled their revenue since then. This bottom chart starts in 2013, which is right here. So it does look fairly similar to the bottom chart and the top chart if you compare 2013 on. You see how this jumps up? I wish I could overlay the revenue chart onto this top chart, but they come from 2 different programs. I'm sure I could if I spend like an hour, but it's kind of a waste of time. In the past 5 years, Pan American is down 8%, while the silver ETF, SLV, is up 41%. And you can see they track each other pretty closely, at least up until mid-2022. They were almost exact. But then they really split apart since then. I imagine they're going to merge once again, because this stock should track silver pretty closely. They do pay a pretty good dividend, 2.5%. They pay 10 cents a share. It's up from 4 cents in 2018. We can't really look at that payout ratio since they have negative net income. Same thing with the dividend over free cash flow. We can't look at that. There are 5 companies in the same industry as Pan American, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend a lot on CapEx, a lot more than most. All the companies on this list have a good debt to equity ratio. By far, they pay the highest dividend on the list. They have the biggest negative in free cash flow. They're the largest company on this list, larger than the other 4 companies combined. They don't have good price multiples. Their price to book is the worst on the list. Same thing with their price to sales, and we can't look at their PE or price to free cash flow. They do generate the most revenue of all the companies, and their 5-year annual revenue growth rate is 12%. Lower than First Majestic and lower than Fortuna. So to summarize, I have them trading at a 2% discount. They've been around 29 years, and they seem to be a fairly stable company. The real question you need to ask yourself is if you want exposure to silver and gold also. Owning commodities is a nice hedge against the market, because generally, if there's a bear market, commodities should do better. But if it's a really strong bull market, you can expect the commodity to lag. So it is a nice hedge, although there were times when there was a severe bear market and commodities did terrible. The nice thing about commodities is they're going to always be in demand. Even if you look at the best companies in the world 20, 30 years ago, some of them might be out of business or struggling today. It's very rare for a business to last forever, but the demand for commodities will always be there. I rank their free cash flows 3 out of 10, their revenue 4 out of 10, and their ratios 2 out of 10. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to become a member, you can click on the link in the description below. Thanks for watching.